Hey everyone, welcome back. Today we're diving deep into excerpts you sent us from the audiobook of The Intelligent Investor by Benjamin Graham. A
Classics.
true classic in the world of finance, and our mission today is to help you understand the core principles Graham lays out, especially his distinction between intelligent investing and speculation.
Right.
And trust me, we've got some fascinating stuff to cover, from the dot-com bubble's wild ride
Oh, yeah.
to how even Sir Isaac Newton got caught up in a speculative frenzy and lost a fortune.
It's a good story.
Plus, we'll explore Graham's timeless advice for navigating tricky stuff like inflation and interest
All
rates.
right.
All right, so
What's remarkable about Graham's approach is that he doesn't just focus on financial knowledge,
yeah,
he delves into the psychology of investing. The intelligent investor is just as much about cultivating the right mindset as it is about picking the right stocks.
and that's what I find so intriguing about this book.
Yeah.
It's not about some secret formula or get-rich-quick scheme.
Yeah.
It's about building a solid foundation for long-term success, which aligns perfectly with your learning style.
Exactly.
So let's jump right in. How does Graham define an intelligent investor? What sets them apart?
Well, Graham emphasizes that being an intelligent investor has nothing to do with IQ or some innate talent for finance.
Yeah.
It's about cultivating specific qualities like patience, discipline, and emotional control.
Mhm.
It's about being able to detach yourself from the hype and fear that often drives the market.
That makes a lot of sense, especially in today's world where we're bombarded with financial news and opinions 24/7. It's easy to get swept up in the noise and make impulsive decisions.
Exactly. And, Graham uses a captivating historical example to illustrate this point, the story of Sir Isaac Newton and the South Sea Bubble.
Oh, wow.
You wouldn't think that a mind brilliant enough to unravel the laws of gravity could fall prey to market mania, but that's precisely what happened.
Wait, so you're telling me the guy who basically figured out how the universe works
Mm.
lost his shirt in a speculative bubble? Now, that's what I call a cautionary tale.
It certainly is. Even a genius like Newton couldn't resist the allure of easy money and ended up losing a fortune. It highlights the powerful psychological forces at play in the market and why Graham stresses the importance of emotional discipline.
Wow, that story perfectly sets the stage for understanding Graham's core distinction between investment and speculation.
Mm.
It feels like he's really hammering home the point that no matter how smart you are, you're not immune to the dangers of speculative frenzy.
You hit the nail on the head. Graham defines an investment operation as one based on thorough analysis, promising safety of principal, and an adequate return. Anything that deviates from this, where risk outweighs reasoned analysis, is considered speculation. And Graham cautions that speculation disguised as investment is especially treacherous.
Especially for someone like you, whose goal is likely to build lasting wealth. Understanding this difference is absolutely crucial.
Right.
It's about avoiding those get-rich-quick traps and focusing on strategies that stand the test of time. It seems Graham was really ahead of his time, especially when you consider the dot-com bubble of the 1990s. Did he have any thoughts on that era, even though it happened after his book was published?
Absolutely. In fact, many of Graham's warnings about speculation directly apply to the dot-com craze. Think about the rise of day trading, the obsession with hot internet stocks and strategies like the Foolish Four.
Oh, yeah.
All these trends prioritize speculation over sound investing principles.
It's almost as if Graham could see the future. Listening to this, I'm starting to understand why his book is considered a timeless classic.
Right.
These principles are just as relevant today as they were decades ago, maybe even more so in our fast-paced, information-saturated world.
You're absolutely right. And speaking of navigating a complex world, Graham had some profound insights into market fluctuations and investor psychology, things that can really throw you off course if you're not careful.
I'm all ears, especially considering how volatile the market can be these days. I bet our listener is too. So how does Graham suggest we approach those inevitable ups and downs?
Well, Graham brilliantly uses the analogy of a pendulum swinging back and forth between unsustainable optimism and unjustified pessimism to describe market fluctuations. He argues that instead of getting rattled by these swings, the intelligent investor should exploit them.
So in a way, those market dips, while scary, can actually be opportunities in disguise. It's almost like the market is having a sale, and if you know what you're doing, you can get a bargain.
That's precisely it. He even compares it to buying groceries when prices are down. You stock up, right?
Right.
The same logic can apply to stocks. It all comes down to having the emotional discipline to resist panic selling and see those downturns as buying opportunities.
I'm starting to see a pattern here. It seems like a lot of Graham's philosophy comes down to mastering your emotions and not letting fear or greed dictate your decisions.
Exactly, and this ties into his skepticism about trying to time the market or predict the future. He believed it's far more effective to focus on what you can know the underlying value of a business rather than getting caught up in speculation.
Which brings us to another one of Graham's key concepts, the margin of safety. This seems like a powerful tool for someone who wants to minimize risk and ensure their investment decisions are sound.
Right, the margin of safety is essentially a buffer against overpaying for an asset.
Okay.
It's the difference between the price you pay and the intrinsic value of the business. The larger the margin of safety, the lower your risk.
Okay, that makes sense. It's like having a built-in cushion to protect you from unforeseen circumstances or mistakes in your analysis.
Exactly. And it goes back to Graham's emphasis on being a defensive investor.
Yeah.
You're not swinging for the fences, hoping for a home run. You're strategically protecting your capital while seeking opportunities for steady growth.
Oh. So far, we've covered a lot of ground, from defining the intelligent investor to exploring the difference between investment and speculation. We've even touched on Graham's views on market fluctuations and the importance of the margin of safety.
And it's important to remember that this is just the tip of the iceberg.
Right.
The intelligent investor goes even deeper, exploring specific strategies for both defensive and enterprising investors.
All right, listener, buckle up, because in the next part of our deep dive, we'll delve into some of those specific strategies that Graham outlines, and we'll see how his insights hold up in today's ever-changing market. But before we move on, I want to touch on a few things you mentioned at the beginning: inflation, interest rates, and the danger of relying on hot tips.
Right.
Those are all very relevant concerns for investors today.
Absolutely. And Graham had some insightful perspectives on those topics as well, which we'll be sure to cover in detail. His advice on navigating inflation and interest rates in particular is surprisingly timely given the current economic climate.
Perfect. We'll save that for next time. See you soon.
Picking up where we left off, let's explore some of the strategies Graham suggests for the enterprising investor, someone who's not just dipping their toes in the investment waters, but is ready to swim a few laps.
Okay, so we're talking about someone who's willing to put in a little extra effort and go beyond the basics. I bet our listener is eager to hear about these strategies, especially since they took the time to send in these specific excerpts.
Right. One of Graham's most intriguing suggestions is for enterprising investors to focus on companies selling for less than their net working capital value. Essentially, you're aiming to buy $1's worth of assets for less than $1.
Wait, are you saying there are companies out there whose stock price is actually lower than the value of the stuff they own? That sounds almost too good to be true.
It might seem counterintuitive, but these opportunities do exist. Of course, it requires careful analysis. A bargain basement price doesn't automatically make it a good investment. You need to understand why that price exists in the first place.
So it's like being a financial detective, right? You're looking for clues in the company's balance sheets and financial statements to determine if it's a genuinely good investment or if there's a hidden reason for that low price.
That's a great analogy. Thorough analysis is crucial. Graham provides a detailed framework for evaluating a company's financial health, looking at factors like earnings, debt levels, and the value of their assets. But he also cautions against getting too caught up in trying to predict future growth.
That makes sense. It's easy to get swept up in the hype of the next big thing, but as we learned from Sir Isaac Newton, even brilliant minds can get it wrong.
Exactly. And Graham believed that focusing too much on future growth can lead to costly mistakes. Instead, he advocated for a more grounded approach based on a company's current financial strength and a healthy margin of safety.
Speaking of margin of safety, I'm curious how that concept plays into specific investment strategies. Is it something enterprising investors should be even more mindful of?
Absolutely. The margin of safety is crucial for any investor, but especially for those taking a more active approach. Remember, it's that buffer against overpaying for an asset. And since enterprising investors might be delving into more complex situations, having that extra layer of protection is essential.
Okay, that makes sense. So besides looking for undervalued companies, what other strategies did Graham recommend for the more enterprising investor?
Well, you're already familiar with dollar cost averaging, but Graham had a unique perspective on why it's such a powerful tool, particularly for navigating unpredictable markets.
I'm always fascinated by the psychological aspects of investing. It seems like Graham really understood how our emotions can get in the way of making sound decisions.
He did. With dollar cost averaging, you're essentially taking the guesswork out of timing the market and letting your steady discipline build wealth over time. It's like having a secret weapon against your own emotional impulses.
So instead of trying to perfectly time the market, which is nearly impossible, you're consistently investing a set amount regardless of what the market is doing.
Precisely when the market is down, you're buying more shares at a lower price when the market is up. You're buying fewer shares at a higher price over time. This approach can help smooth out the bumps and potentially reduce your average cost per share.
I'm starting to see why Graham dedicated an entire chapter of his book to investor psychology. Understanding our own biases and emotional reactions to the market seems just as important as understanding financial statements.
Absolutely. Graham believed that the biggest obstacles to successful investing are often internal, not external fear and greed, can lead to impulsive decisions that undermine long-term goals.
You know, it's fascinating how many of Graham's principles go beyond just picking stocks. He's really offering a framework for making sound decisions in all aspects of life.
That's one of the reasons the intelligent investor has remained so relevant for decades. It's about cultivating a mindset that prioritizes patience, discipline, and rational thinking qualities that are valuable in any field, not just finance.
Okay, so we've discussed looking for undervalued companies and utilizing dollar-cost averaging. What other gems did Graham have up his sleeve for enterprising investors?
Well, he had quite a few, but one that I think is particularly relevant for today's listener is his emphasis on not following the crowd. Graham was a strong advocate for contrarian thinking, buying when others are fearful and selling when others are greedy.
That sounds incredibly difficult to do in practice, especially when you see everyone else seemingly making a killing in the market. It goes against our natural instincts, wouldn't you say?
It does, which is why it requires a strong sense of self-awareness and the discipline to stick to your analysis, even when the crowd is heading in the opposite direction. Remember, Graham was writing this in a time before the internet, and 247 news cycles. Imagine how much harder it is to tune out the noise and think independently in today's world.
That's a great point. It's almost like we're constantly bombarded with information and opinions that can cloud our judgment.
Exactly, and that's why Graham's emphasis on independent thinking is more important than ever. He encourages investors to develop their own judgment based on careful research and not be swayed by the whims of the market or the latest hot tip.
Speaking of hot tips, that was one of the topics you mentioned at the beginning that we wanted to explore further. Did Graham have any specific thoughts on the dangers of relying on those kinds of insights?
He certainly did. In fact, Graham considered following hot tips to be one of the most dangerous forms of speculation. He believes that relying on external advice, especially from unreliable sources, is a surefire way to make costly mistakes.
You know, it's interesting to think about how this applies to today's worlds of social media and online forums, where investment advice is thrown around so casually.
It's a minefield out there. Graham would likely caution investors to be extremely wary of any advice that promises quick riches or relies on inside information. Remember, his philosophy is built on a foundation of thorough research and a deep understanding of the businesses you're investing in.
It all comes back to that core principle of being an intelligent investor, doesn't it? It's about taking control of your own financial destiny by making informed decisions based on sound principles, not chasing after shortcuts or relying on the opinions of others.
Exactly. And that brings us to another important aspect of Graham's philosophy that we haven't touched on yet, his views on inflation and interest rates, particularly in the context of long-term investing. These are forces that can significantly impact your returns, and Graham had some valuable insights on how to navigate them effectively.
This is all starting to make so much sense. It's like Graham is giving us a roadmap for not only surviving, but thriving in the ever-changing world of finance.
And just like any good roadmap, it requires careful study and the willingness to follow its guidance. So let's shift gears and explore how Graham viewed the impact of inflation and interest rates on intelligent investing.
All right, listener, get ready for another deep dive, because in this next segment, we're going to uncover why Graham considered these factors so crucial, and we'll see how his insights can help you protect and grow your wealth over the long haul. All right, we're back and ready to tackle those big picture forces that Graham warned every intelligent investor needs to understand: inflation and interest rates.
Right.
These aren't always the most exciting topics, but they can have a huge impact on your returns over time.
Oh, absolutely. Yeah, it's easy to get caught up in the day-to-day fluctuations of the market, but ignoring these broader economic trends is like sailing a ship without paying attention to the currents.
So how did Graham view inflation? Did he see it as a major threat to investors?
Well, Graham recognized that inflation is a constant challenge for investors because it erodes the purchasing power of your money over time. What you could buy with $1 10 years ago won't get you nearly as much today.
That's a really good point. It's like a silent thief chipping away at your savings without you even realizing it.
Exactly, and that's why Graham stressed the importance of investing in assets that can outpace inflation. He believed that stocks over the long term have the potential to provide returns that exceed the rate of inflation, unlike fixed income investments like bonds.
That makes sense. If the value of your investments isn't growing faster than the rate of inflation, you're essentially losing ground.
Precisely now, interest rates play a crucial role in this equation as well. Graham understood that interest rates and bond yields directly impact the attractiveness of stocks. When interest rates are low, bonds offer less appealing returns, which can drive investors towards the stock market, potentially pushing prices higher.
So it's like a seesaw effect. When bond yields go down, stocks become more attractive and vice versa.
That's a great way to visualize it.
Mm.
And Graham observed that this relationship can create both opportunities and challenges for investors during periods of high interest rates, for example. It might be more tempting to invest in bonds for their steady income. But Graham cautioned against making drastic shifts in your portfolio based solely on interest rate fluctuations.
It seems like Graham was advocating for a balanced long-term approach, regardless of the short-term fluctuations in the market or broader economic conditions.
Exactly.
Hmm.
He believed that intelligent investors should focus on building a diversified portfolio that aligns with their risk tolerance and long-term goals, rather than trying to chase short-term gains or time the market based on interest rates or inflation predictions.
This all connects back to his emphasis on being a defensive investor, right? Protecting your capital and seeking steady, sustainable growth over the long term.
You got it. Now, remember at the beginning of this deep dive, we talked about how Graham was skeptical of relying on hot tips. Well, his views on interest rates and inflation tie into that skepticism as well.
I'm curious to hear how that all connects. Was he suggesting that people shouldn't pay attention to economic forecasts or expert opinions on interest rates?
Well, Graham wasn't saying that you should completely ignore these forecasts, but he believed that investors should be wary of basing their decisions solely on predictions, especially those related to complex economic factors like inflation and interest rates.
So it's about taking those predictions with a grain of salt and focusing on what you can control your own investment strategy and the quality of the businesses you invest in.
Precisely. And that brings us to another key aspect of Graham's philosophy that we haven't touched on yet, the importance of dividends.
Oh yes, dividends. I know some investors see them as a bit old-fashioned, especially in today's world of high-growth tech stocks, but I have a feeling Graham had a different perspective.
He did. While many focus on a stock's potential for price appreciation, Graham saw consistent dividend payments as a vital sign of a company's financial health and stability.
So it's not just about the extra income that dividends provide, it's about what those payments tell us about the underlying business.
Exactly. A company that consistently pays dividends is demonstrating that it generates real cash flow and is committed to sharing its profits with shareholders. It's a sign of stability and shareholder friendliness, two qualities that Graham highly valued.
Okay, that makes a lot of sense. It's like a company putting its money where its mouth is, so to speak. They're not just talking about profitability. They're actually sharing those profits with their investors.
And remember, Graham emphasized the importance of investing in businesses, not just stocks. A business that returns a portion of its profits to its owners through dividends is generally a healthier investment than one that doesn't.
So it's another clue that we're dealing with a solid, profitable company that's committed to rewarding its shareholders, not just a speculative bet on future growth.
Precisely, Graham also saw dividends as a way to mitigate risk when a company pays a dividend. It's essentially putting money back in your pocket, reducing your reliance on the often unpredictable swings of the stock market.
I see. It's like having a built-in safety net. Even if the stock price fluctuates, you're still receiving a steady stream of income from those dividend payments.
That's a great way to think about it. And remember, Graham was all about minimizing risk and maximizing returns. Dividends can play an important role in achieving both of those goals.
Now I'm curious about how Graham viewed dividend policy. Did he have any specific recommendations for investors when it came to analyzing a company's dividend history?
Well, Graham generally favored companies that paid out a reasonable portion of their earnings as dividends. He saw it as a sign of management's prudence and commitment to returning value to shareholders. On the other hand, a company that hoards all of its cash might raise a red flag for the intelligent investor.
Okay, so it's not just about the size of the dividend, but also about the company's overall approach to distributing profits to its shareholders.
That's right. And Graham also pointed out that dividends can be a powerful force for compounding returns. When those dividends are reinvested, they start generating their own returns, leading to exponential growth over time.
The magic of compounding. It's like a snowball rolling downhill, gathering more and more snow as it goes.
A perfect analogy. Graham believed that even a modest dividend yield, when reinvested over time, could significantly boost an investor's overall returns, especially when combined with a long-term investment horizon.
Wow, so we've covered a lot of ground in our deep dive into the intelligent investor. We've explored Graham's definition of the intelligent investor, the crucial distinction between investment and speculation, and the importance of strategies like margin of safety dollar cost averaging and focusing on dividends.
And we've seen how Graham's principles are just as relevant today as they were when he first wrote the book, maybe even more so given the complexities of the modern financial landscape.
Before we wrap up, I want to leave our listener with a final thought-provoking question that Graham raises in his book. He mentions that even charitable institutions known for their long-term outlook were once advised to go 100% into stocks.
That's right. And it highlights how investor sentiment can shift dramatically over time, even among those who are supposed to be the most risk averse.
So here's the question for you, listener, considering everything we've discussed today. What do you think about that advice? Would you feel comfortable putting all your eggs in the stock market basket, even if it meant supporting a worthy cause? What would Graham say?
It's a question that goes to the heart of Graham's philosophy and challenges us to think critically about our own investment decisions. He would likely emphasize the importance of diversification risk management and aligning your investment strategy with your individual goals and circumstances. There's no one-size-fits-all answer.
And on that note, I want to encourage you to revisit The Intelligent Investor and continue your exploration of Graham's timeless wisdom. It's a journey that's sure to pay dividends for years to come. Until next time, keep those knowledge gears turning.